Dave Ramsey once said that those who don't manage their money properly will always work for those who do. And with the mother of all default cycles now upon us, we can't help but feel that this is the year when his words will echo through the most. Driven by the sky-high interest rates, Apollo Management, one of the biggest private equity firms with over $500 billion in assets, suggests that the next phase in our economic cycle has begun. And yeah, it's definitely a brow raiser. That said, you might want to grab a snack or two because, apart from breaking down every single detail there is to know about this big change, we are also going to be dissecting what it means for the average Joe, why you need to get worried if things are indeed as bad as you believe, and, of course, the ultimate solutions to the impending crisis. But spoiler alert, if you play your cards right, you will make a lot of money. But first, what exactly is a default? Well, there are a gazillion ways to define this, but to make things pretty easy, a default is a time when a borrower fails to fulfill their obligation to either repay a loan or meet the terms of a financial contract. It could be due to a layoff, a reduction in income, or even negligence. But in any case, you no longer have the ability to pay off your debt, leading to various consequences such as penalties, increased interest rates, or legal actions by the lender. And this is one of the reasons why Dave Ramsey is always so blunt about why debts are bad.
Our data says that the shortest direction, the shortest distance between you and wealth is having no debt.
Apollo Management has talked about two different types, personal and corporate defaults. The former typically involves a person going out and financing something for their life before suddenly losing the ability to pay for it. The latter, however, is a bit different. This involves companies or firms buying something for themselves and then struggling to pay off the required debt. Got it? Cool. Because there's something we'd like to add about the personal defaults. Currently, the default rates for auto loans and credit cards for consumers are steadily rising. Why? Well, because of the higher interest rates. And like that wasn't already a pain in the back, there's still the issue of a higher cost of living due to the recent inflationary trends. As things stand, most can't afford to have a comfortable life to handle all of their needs and wants. So how could they possibly pay off their loans when the odds are so stacked against them? And guys, it gets worse. When people can't pay off their debts, banks won't get paid in the form of interest, and this could affect other parts of the general economy. Can you finally understand why Apollo Management is ringing the alarm bells? If interest rates stay up for long, which is already what they predict, there's no telling when the credit card and auto loan defaults will come to a halt, or, hey, go down at the very least. And according to Dave Ramsey, it will be one of the major reasons why Americans will find it impossible to build wealth.
If you stay out of car payments the rest of your life, it is one of the key elements, one of the key data points that indicates towards building wealth.
Now let's get into corporate defaults once again to illustrate the gravity of the crisis. Did you know that from 2020 to 2022, bankruptcy filings were very low? Part of the reason for that has to do with lower interest rates, allowing businesses to refinance their debt on a cheap basis. But everything changed when the Federal Reserve Bank started hiking interest rates. Debt costs increased, and now bankruptcy filings are going higher, with no indication that it could stop soon. But here lies the million-dollar question. What exactly is going to happen if interest rates stay higher for much longer? Apart from the obvious fact that Dave Ramsey insists it could make things very difficult for real estate, let's take a look at a pretty interesting chart effectively showing the number of distressed loans out there. As you can see, since March 2022, when the Federal Reserve Bank began to raise interest rates, there has been a notable increase in distressed loans, indicating companies are facing challenges in repaying their debts. And guess what? This kind has a twofold effect on the corporate debt market. Because corporations are struggling to generate sufficient income, they're going to find it more challenging to secure additional funds when interest rates are elevated, ultimately leading to bankruptcy. How about the distressed loans? Just imagine a small tech company with existing debt structured like a variable rate loan. Every few years, when interest rates surge, their debt readjusts, meaning they'll have to pay more. If the company struggles to meet these increased payments, it may face financial difficulties, strain relations with lenders, and again, bankruptcy. But make no mistake here, it's not just people and corporations that are going to suffer from this next phase of the economy. Key players in the commercial real estate market will also be affected. Take a look at this chart showing commercial real estate loans. Notice the pattern? The number of commercial real estate loans has been growing since 2007, with banks extending more money to commercial real estate. To be fair, this is not a bad thing, but since the recent global pandemic, there has been a change in the status quo of the commercial real estate market. Some firms have gone hybrid, others have gone remote, and a couple have even downsized their office space. You can walk into an office today and see vacant spaces, a far cry from the past decade. So, if interest rates stay higher for longer, this commercial real estate debt will also be up for refinancing in the next year or two. This is when we might start seeing a wave of challenges because commercial real estate debt, like corporate debt, is often not a 30-year fixed mortgage. It's usually around a 5-year adjustable rate mortgage. Over the next year or two, as a lot of commercial real estate debt needs readjustment, office landlords might face challenges. If your building isn't generating sufficient revenue, and your costs increase not only due to inflation but also higher debt servicing, it creates a situation where revenue falls short, expenses rise, and this could potentially lead to more default problems, as suggested by Apollo Management. But hey, now that we've looked into the recent developments in consumer and corporate loans, let's dive into the broader economic landscape in the United States, which, according to Apollo Management, is also contributing to a lot of changes in the economy and debt market. But first, let's start with what the Federal Reserve Bank has been up to. For most of the pandemic, the Federal Reserve Bank practiced quantitative easing, which essentially involved the creation of more money. Remember Dave Ramsey's iconic quote, "Debt is dumb and cash is king"? Well, it's the perfect illustration. The Federal Reserve Bank infuses funds into the economy to help the government. Why? Because when the American government wants to spend crazy amounts of money, ranging from hundreds of billions to even $1 trillion, they need to generate the set amount from somewhere, and taxes and crowdfunding from investors are usually not enough. And even if they decide to borrow from other wealthy nations, they will only be able to get so much because of the limit on how much other countries will lend. So, in cases where the aforementioned parties fail, the Federal Reserve Bank, which has the ability to print money, becomes the silver lining. However, it's crucial to note that the Federal Reserve Bank isn't just a wish-granting institution. They don't just hand money to the government, but rather lend it in buying treasuries. This means the government owes this money back to the Federal Reserve Bank, plus interest, as the Federal Reserve Bank effectively creates money out of thin air. But here's where things get pretty interesting. This quantitative easing, where the Federal Reserve Bank continually prints and injects money into our economic system, has now changed. Instead of quantitative easing, what we're now seeing is quantitative tightening, as a result of the inflation challenges stemming from printing loads of cash. And to fight this inflation, the Federal Reserve Bank is doing two things: raising interest rates and engaging in quantitative tightening. The first is kind of self-explanatory. Borrowing costs increase, making it harder for both individuals and businesses to borrow money. We've talked about its effects pretty extensively in today's video already, so we're just going to switch it a bit to the second point, quantitative tightening, which is the Federal Reserve's effort to reduce the amount of money in circulation as a measure to combat inflation by withdrawing it. And guys, Apollo Management underscores this point because a reduced money supply, resulting from the Federal Reserve's balance sheet reduction, can pose challenges for borrowing. With a diminished pool of dollars, corporations might encounter increased difficulty in securing the necessary funds. And to make things even worse, there is a current scarcity of favorable debt compared to how things were before. Take a look at this chart from Fitch Ratings and tell us what you see. Can you notice how there's been a significant decline in the number of these high-rated companies between the early 2000s and now? This decline implies a shift in risk for investors. But hey, what if we also told you that this is still an amazing opportunity? If there's one thing we've learned from Dave Ramsey, it's the fact that there's always a bigger picture. Even in disastrous climates like the Great Depression and 9/11, the economy still recovered, and some people even got richer. At present, there's a historically low debt-to-equity ratio, presenting what they see as a unique opportunity. In case you had no idea, a low debt-to-equity ratio indicates that a company holds a reduced amount of debt in comparison to its overall value or equity. And with Apollo Management also saying that they're looking for strong companies with relatively low amounts of debt and the ability to pay out higher interest rates as they seek a safer investment with higher returns, can you see where we're going? Pay attention, guys. High interest rates are bad, but economics has a pretty funny principle. Basically, anything bad has a benefit, and anything with a benefit usually has its drawbacks. Puzzled? Well, allow us to elaborate. Given the fact that investors can potentially obtain more positive returns by lending money compared to the period when lower interest rates were paired with high inflation, wouldn't you say that's a potential benefit? Let's illustrate this point using Ben, a savvy investor who recognized the potential for higher returns during a period of rising interest rates and inflation. He decided to lend money to a promising small tech company looking to expand. And as interest rates increased, the company, facing higher borrowing costs, successfully utilized the funds to innovate and grow. When the tech company repaid the debt, Ben experienced a more lucrative return on his investment due to elevated interest rates. But that said, don't just blindly apply this investment strategy all willy-nilly. It's crucial to assess the credit worthiness of the company and the associated risks before making such investments. Higher interest rates can also pose challenges for businesses, potentially affecting their ability to service debt. But guess what? You don't need to follow Apollo Management's strategy to win in the new phase of the economy down to the last letter. Instead of just investing in a company's debt, you could also buy bonds in the firm, creating more lending investment opportunities. You see, when you purchase bonds, you essentially lend money to the company or government that issued them. The interest payments on bonds, also known as coupon payments, provide a fixed income stream to investors. So, in a rising interest rate environment, newly issued bonds may offer higher interest rates, making them attractive to investors, like in the case of Bethany, our imaginary investor who strategically opted to buy bonds issued by a reputable company during a period of rising interest rates. By buying these bonds, she was able to get a lock in a more favorable yield compared to what the new investors were getting. This means that while others were investing in new bonds with lower yields, Bethany continued to receive steady, higher interest payments from her existing bond. But alas, it's pivotal to note that all of these strategies are going to depend on what the Federal Reserve Bank is going to do until the end of the year. If they start cutting interest rates aggressively, you can expect interest rates to also fall. But if they keep interest rates higher for longer, then that creates more debt investment opportunities. Nevertheless, one thing is for sure, the tides are changing, and the economy is now more unpredictable than ever before.